We are going to hear more from you about your particular journey with bonds in the future. But for right now, we're going to ask Bro to help us kind of explain the basics of bonds. In fact, you've got 5 things that everyone needs to understand about bonds.
Right. So one of Todd's points was that most people should have bonds, or especially in a retirement portfolio. And I would say, first of all, I agree. And in my early retirement service, that's one of the actually places in the Motley Fool we actually do discuss bonds. So I'll just say he's right about that, and it is important to know. Very quickly, make sure that we're all on the same page about bonds. First of all, a bond is a loan. Basically, if you buy a $1,000 bond, you are lending $1,000 to whoever issued it. Could be a government, could be a company, and there's certain terms with it. It might be a 5-year bond. It pays you 3%. You're going to get 3% of that $1,000 each and every year. And after 5 years, assuming the issuer is still in business, you get your $1,000 back. Number 2, the bond market is actually huge. It's bigger than the stock market. According to an article in the Wall Street Journal from last October, the U.S. stock market is worth $26.3 trillion. The U.S. bond market is worth $39 trillion.
Oh, wow. So not a small chunk of change difference.
No,
Yeah.
and globally, it's even a bigger deal. So the bond market is huge. Number 3, there are all kinds of bonds. And this is a point Todd made in his email, so I'm just going to quote what he said. He said, stop talking about bonds as if they are all the same. As you know, there are treasuries, municipal, investment grade, high yield, asset backed. All these bonds are different and should not be lumped together. And he's absolutely right. You can go with the super safe bonds, which are U.S. treasuries. For the most part, I think we all believe that the U.S. government will stay in business. You're going to get your money back. You're also not going to earn a huge return. On the other end of the spectrum are so-called junk bonds. These are companies that are in trouble. Because they are in trouble, they have to offer a high yield on their bonds. You can get from there 8, 9, 12, 14%. Are you guaranteed to get the money back? Maybe not, but that's the risk you take. Number 4, they historically do have lower returns than stocks, and this is partially why you don't hear as much about them. Over the long-term, bonds in general have returned about half of what stocks have. That said, they don't go down as frequently or as much. So while the stock market goes down roughly once every 4 years, the bond market maybe once every 7 to 10, and a decline of 5% is a bad year for bonds, the overall bond market. So that's why people choose them. They're not as risky, and you can get some interest along the way. And the final point is you can buy bonds individually, as Steve does, and he will discuss, or through mutual funds, which is the easiest way to do it. But those also have some drawbacks, as I know Steve believes, and as Todd pointed out in his email, in which we might discuss here. But the easiest way for most people is a low-cost bond fund, but there's some pros and cons to that.
I feel like the conventional wisdom is that, man, is this some weird rule of thumb that is probably really wrong, or I'm totally
Bonds
butchering?
equal your age.
Yes, exactly. You're supposed to have as whatever percent of your portfolio in bonds as your age. So if I'm 70 years old, I should have 70% of my portfolio in bonds.
Right, and that's been adjusted somewhat, where people now say you start with 110 minus your age, and that's how much should be in stocks. So that makes it a little bit more aggressive. So that old saying of your age in bonds has people feel is a little too conservative, but still it's an interesting starting point. There are people like even John Bogle, the founder of Vanguard, who will often say that's a good starting point.